Okay, now let's talk about banking. Now, this is one sector where we know that markets in terms of in positioning or the index in terms of positioning has a large heavyweight. And for the first time, at least looking at the numbers which and commentary, we now feel that all banks have three things in common. NPAs are down, credit offtake has started, and the retail engine now seems to be stabilizing. But our market's factoring in all that. And if we are on the verge of a new capex cycle indeed, what is the best way to understand and really participate in this economic upturn? Vishal Goyal joins us, represents UPS. For the longest time, I've really read his work and admired his intellect and research. So Vishal, fantastic to have you back. Thank you for joining us. For the first time, we can convincingly say that banks are out of the woods. But out of the woods does not mean that a new cycle has started and you can start running again. What is your view? Worst is behind us?
Thanks for your kind words. I feel that, yeah, I think it's a very ripe environment, for a good cycle, to begin. As you remember from maybe early 2004 or even 2011, I think we had very similar backdrop. I think the corporate backdrop is the strongest, as we can see, especially after the deleveraging which has happened and the cleansing of NPL. Plus, also there has been significant improvement in the underwriting processes of these banks. So all that actually is great to start with. And as you kind of hinted at, is what is lacking is growth, or the visibility of growth for the time being. So if you think about growth, especially on the loan growth side, there are three key drivers, right, in India. One is consumption, which is still growing at a decent pace and therefore should be driving the retail loan growth. But that's still a very small portion of overall banking system. So it doesn't, change the big, the aggregate numbers so much. So what we need is we also need the corporate book to grow or start growing. Now, one part of corporate book, which is, you can argue 50-60% of the corporate balance sheet lending is working capital. That I think with inflation, with demand recovery, with sales growth, we should see, again growing at maybe double digits. But the investment cycle related growth, I think, is still lacking. There are some green shoots, some discussions around it, but nothing significant to start building a big loan growth for a couple of years. So the visibility we get today is yes, we can hit a double digit loan growth, but are we talking about the mid teens yet? I think we need to see a lot more investment and capex improvement for us to go back to those kind of growth at the system level. I think that is something. Even in the recent quarterly earnings, I think almost all the discussions were around that, about where the loan growth will come from.
Vishal, when the last corporate cycle started, smaller banks also participated a lot, and in fact they were big beneficiaries because they compromised on their credit quality to get better yields and better spreads. Do you see a similar kind of a cycle panning out itself? Starts with the big banks, goes to the smaller banks, and for an investor, you have to buy the stock before the actual cycle starts. It's a good time to buy into smaller banks also.
So I think smaller banks per se is not a problem. What we need, or at least what we generally look for, is whether the underwriting style or the process or the credit culture which actually led to the big NPL cycle in let's say in last 5-7 years, whether that is significantly changed or no. So if a small bank has significantly changed that process, and that will start reflecting in the way they are lending and the kind of credit ratings their book would have once the growth starts to pick up, and plus also the channel checks will also reveal some of that. We need to see that. I don't think there is anything wrong in small banks, but what actually now investors are extremely cautious, or I would say more discerning about giving capital to banks who who've not done, well in past, and also have not changed much. So that is the only concern I would have, for smaller banks, if they have not, changed completely the way they've been doing business.
So if I compare the last credit cycle, and since the credit cycle has dawned on us, we both agree with that. Everybody agrees with that. Why just we both? Everybody agrees that a new credit cycle has dawned on us. The difference between the last cycle and this cycle is that you have a word called fintech, which was not there when the last credit cycle started. This time it's there. What will the fintech world, where SME lending has started, where microfinance lending has started, how will that change the dynamics of this credit cycle?
So there are 2 or 3 parts on the fintech related, impact. Number one, I think is, can fintech, really fund those, loans or growth? I think the answer is that will be finally be funded by the banks. Then essentially fintech would become another intermediary in terms of originating, maybe helping underwrite some of the loans which were, earlier were out of reach. All that actually leads to spread compression effectively, right, for the segment, for especially for the banks. Plus, I think what percentage of segment really fintech can reach. So there are two, as you already mentioned. One is the consumer lending, and second is the SME financing. So both these segments, fintech can clearly serve much better than banks, because they are, they have more engagement, or different. They are basically agile and more flexible in the way they are offering solutions. But the way I think about it is, it's more like a additional cost on the bank for that part of lending, rather than the whole balance sheet, moving to a new player. At least that's not my understanding from speaking to fintech. I think none of the fintech wants to really build a big balance sheet. All of them want to keep it asset light and want to be a platform, kind of a business.
Hi, Vishal. So, just to build upon this point, I think in the 90s, when Bill Gates said that we will have banking, not necessarily banks, a lot of us thought, what is he talking about? But, what we are seeing pan out, and the collaborations that we're also seeing between banks and fintech, there may be a Kotak had an advantage. Look at the way SBI YONO has done. You've been hearing about other partnerships also now between fintechs as well as banks. Is this the way to go, and therefore will the winner in the traditional banking landscape be the ones who forges better partnerships or just more partnerships?
Yes, I think it will be both. One, banks who are quicker, faster, agile, who have better, I would say, let's say, technology for simplicity's sake, core, who can partner faster and with larger, a large number of fintech. Definitely they will be able to serve their customer base much better compared to banks who are completely relying on their own solution. But the other side of it is, for example, we already know a couple of these banks have built a tech stack over last 10 years, and their offering is not very different from fintech. It is just the marketing, which is not, enough marketing is not happened, partly because of they don't want to spend that much money on customer acquisition, and partly because they never felt, there is a need to go that aggressive on marketing side. So it doesn't, so I think this fintech uh, debate, I think the way you put it is interesting, because almost all banks I feel would partner. I don't think there will be any bank who would not partner. And at least the names we speak to, almost everybody has some kind of partnership. And it makes complete sense, because all banks have, the legacy tech structures, the talent they really need, right? It's maybe difficult to hire and retain in the current structure. So it makes sense to have either strategic partnership or just some commercial partnership. That I think will continue to happen. And also what would happen is, some fintechs, while they will partner with the banks, would also want to have a separate, a business proposition. So that also would I feel would happen.
What's the mood like at the conference when it comes to the banking space? We were talking to market experts earlier in the day today who said in the last bull run, clearly it was the banks, the private banks, who had been the winners. In this bull run, the financials are, of course, playing catch up, and it's IT, which has turned out to be numero uno. Are you seeing a significant mood change? And not just about the private sector banks, even look at the smaller PSU banks.
Yeah, so I think at the conference, what we hear is I mean, it's an optimistic commentary, definitely. Most of these banks have kind of cleaned up even the second wave related impact. And therefore, what I think, sorry, I think there was some connection issue. So from the banks, asset quality, I think it's becoming less of a discussion point. That is number one. Second, I think, are they optimistic about growth? Almost all banks are optimistic about growth and are feeling confident, given that there is some stability in the environment, that growth would be faster going forward. Then I think, interestingly, on net interest margins, with liquidity, being drained out, inflation, kind of pushing the rate cycle up. So almost all of, the system is expecting our rates to start going up. In that environment, that is generally positive for margins. And therefore, banks are also, kind of confident of holding on to margins, if not, expand. So I think the commentary is pretty optimistic, I must say. And especially, again, from the private sector banks. Yeah, so I think, and that has been changing in the last, couple of quarters. I think there is a marked, improvement in their confidence and commentary.
I have two questions for you, Vishal, and slightly longer term questions. One is purely based on the valuation matrix. At least for the longest part, I have tracked the banking sector. We use price to book as a benchmark to understand that where banks are headed. PSU banks are cheap because they are trading at 1 to 1.5 times price to book. Private banks are expensive because they are trading at 4 to 5 times price to book. The world is changing. How you value stocks is changing. How you value equities is changing. In next couple of years, the way how we value financials, I'm not using banks, financials, will that change? And for us, it is important to understand that.
So, I mean, you've seen enough cycles now, and I don't want to, kind of remind you at least on that. But I think for the sake of discussion, we have this, in real estate, there was some valuation benchmark which was used, right, in 2007-8. For infrastructure, there were some valuation benchmark which was, created to facilitate those valuations. So, I mean, I am a little bit traditional on this. I think when we start using new valuation benchmarks just to justify the excess liquidity in the system which is chasing stocks, we typically, enter a trap from a longer term point of view. We definitely would be right in the short period within that cycle. But time and again, I think it is proven that if you stick to the traditional methods, which is, which is, so for example, I'll tell you the reason I'm saying that. So for example, if RBI were to remove capital adequacy requirements, or when I say RBI, I mean the whole world central bank, then I think we can change the valuation methodology. But till the time there is a tier 1 capital requirement, that basically caps the ability to lend, right, on a per equity basis. And so that is one, I'm just saying that should be a reason to change valuation methodology. Second, let's say Indian bank starts to earn significant revenues from non-lending businesses, which is services related businesses. Then I think we should think about valuation, methodologies. So that is my 2 cents on valuation methodologies. And I think maybe that question is also coming from fintechs and the way, these things are getting valued. So as long as their their growth is not dependent on net worth or tier one, I think we can use any methodology apart from price to book. For banks, I feel that gives you a good base. uh, I've seen people using price to earnings, some other methodology also, but that is only for bull run and bull markets, because price to earning visibility is highest when credit cost actually is very low or below normalized credit cost. In all other time, price to earnings will, I think, will be a trap for banks, for lenders especially.
It is so true. Don't we say this again and again based on cycles that the five most dangerous word in the market are, this time it's different. Final question. If somebody, let's say, invested in a basket of private banks in 2010, Kotak, HDFC Bank and maybe ICICI Bank, you actually had market beating returns. You were able to create decent wealth and your portfolio did reasonably well. For next couple of years, a decade is a long time, but next 3 to 5 years, what would be that big call? Will it be back to corporate banks, stroke PSU banks, or should one stay still with private banks?
Sure. So I think here, since we kind of publish, reports basis 12 to 18 months, view, I think the 3 to 5 year view generally can be very, very different. So I'm just basically, using my 12 to 18 month view here, which is based on whether the balance sheet is, sufficiently cleaned up, or whether there is any incremental asset quality risk. Can there be a double digit NII growth or operating revenue growth? And third would be reasonable valuation, either versus history or compared to peers. So with that framework, I still feel the some of the inexpensive private sector banks, the large private sector banks, are can give you good returns. Maybe some of the large PSU banks who have a healthy ROE, ROA, forecast, can also generate, like higher than Nifty kind of returns. So that is the way, I mean, we are actually kind of, you published 3 to 5 year, very, very simplistically, if you think about it, who is gaining market share, right? And who is not adding balance sheet risk. These are typically, and market share, when I say it's, in NII terms, not just loan market share, like who is growing, market share without diluting margins. So the answer. I think the private sector lenders are still doing it, in the right way, and therefore the compounding, will be available in those names.
That's all the time that we have for discussing with you today about the hot banking and the fintech space. Thanks a lot for joining us.